day and welcome to the Korner Perspective Korner BCI Flexible Fund Manager Commentary for the 6 months to the 30th of June as well as to the 31st of July. We often show this just to remind investors what the fund is about. The whole idea behind a flexible fund is that we have maximum flexibility to move between asset classes. As we've illustrated in the past, we are not afraid to express our view on asset markets and to tilt the portfolio quite significantly, both in asset class and in the underlying assets. The benchmark, reminder, 70% is the capped SWIX, 15% in the JSE SA listed property index, and 50% in STEFI, which is cash. Long-term objective is obviously to offer inflation-beating returns. That's what it's all about. Currently South Africa focused, but with a little bit of an NAV tilt. And then our core philosophy is really one of investing according to value philosophy, but will not sort of fanatically so. Then just having a look at the fund review to June, asset allocation really taken from the MDD, where obviously things like bank prefs are added to equity at almost 74%, cash at 15.3, bonds at 10.8, property basically non-existent. Compare that to the benchmark. Benchmark, as we said, 70% is in the SWIX, STEFI is 15, and property 15. Looking at the asset allocation relative to benchmark, much the same as it was in December. Overweight equities by about 4 percentage points, basically neutral on cash, and then really property underweight 15%, and we'll explain again now. We've done this many times in the past, but we believe it needs repeating because of the significantly underweight position. And then bonds, we're very overweight because there is no benchmark allocation at 11%. Just very quickly, why the weightings? Overweight equity, we see it pretty much as Hobson's choice. We're seeing very good valuations in SA listers, particularly with low PEs, and in the investment companies, very attractive discounts to net asset value. We're also getting dividend yields that compete very nicely after tax with cash. Then the bond and preference share holding, it's really, as we will explain and illustrate later, really because the cash yield has been compressed quite significantly, and we're seeing a bit of value in duration. And then obviously the big bank prefs, we've seen them being taken out with ABSA in the 6 month or in the 7 month period, actually delisting their prefs. So, and then the underweight property we'll go through in some degree of detail. And although we are cash neutral on STEFI, we are probably slightly longer duration than STEFI. All right, just very quickly, why we are still wary of listed property. And really, it comes down to our assessment of where yields are. And we are illustrating just the distributions here and the distribution growth over the next few years. It's a little bit misleading because, unlike in the past, a lot of the listed property companies are not distributing everything. But we believe that's probably prudent and necessary given what we saw, for example, with the COVID slowdown and just how violently markets can turn against you. So we believe some prudence and maybe just retaining a little bit of earnings is probably prudent. And we've basically just taken the JSE property index according to its weighting here. Not that we weighted this, but NEPI is the biggest holding, obviously very much in Eastern European shopping mall focused play. You can see there current yield of almost 8% with 25 financial year earnings growth of about, or distribution growth of 5%, 6.5%, and then in 27, 4.8. So that's really the way the table reads. So there you can say on average probably around 5.5% distribution growth out of NEPI. If you look at Growth Point, obviously Growth Point is not exclusively an SA asset. It's got some, particularly if you look at the Australian operations, we'll trim that back a little bit and effectively down-weighted that slightly over time. Distribution yield at 8.3%, and as you can see there for the next 3 financial years, including the current one, fairly anemic distribution growth, probably on average around 4%. Redefine sitting at 8.9 with distribution growth probably slightly north of 5%. Fortress at 7.2. With growth probably on average around 5% for Kile, 6.5% yield, nice bump up in the 25 the current year, but that's probably somewhat more base effects, and probably averaging on average over the next 2 financial years, probably around 7%, resilient at 7%. And I won't go through all of them, but you get the idea, and there you can see the simple average current yield of 7.5%. That's not awfully much better than you're getting on cash, and at a fair discount to medium dated bonds. And as you can see, on average, distribution growth expected of probably around 6% out of that cluster, and that obviously assuming that rates come off and hold there for a little while. So for us, the key message here is that orange line is the SA 10-year bond yield. And if you look there, all of these yields are trading at a yield discount. And typically you would actually expect, unless there's a low base effect and a lot of growth coming through in the next few years, you would generally expect listed property companies, just from the way the risk universe sits together, to trade at a premium. Here you can see they trade at a fairly significant discount. And given those fairly anemic growth rates around 5%, let's call it on average, we believe it'll take more than 3 years for the yield on the listed property index on the JSE to actually match that yield of the 10-year. So how has this underweight listed property position affected the performance? On the short term, it hurt. If you look here, this is over a little over a 1-year period, a little bit of a rally, obviously, from July, but generally it hurt the performance if you look over let's say a 1-year period, but if you look long term, going back to when the fund was actually created in 2018, you can see there, from an index level of over 5 to the current level of 430, and obviously the periods we're reporting on here are significantly lower. So the longer term net effect is it significantly benefited investors by us being underweight. And as we illustrated, we continue to hold the view that the yields are not compelling enough, and that the risks still remain. Issues such as administered prices in the form of rates and taxes, and electricity and water are all going to eat into those distribution growths over time. And then we thought it's relevant to give a word on bonds, simply because effectively what we should have in listed property, we've largely parked in bonds. You can see there the SA yield curve offering good reward, we believe, for fairly little duration. So if you look at sort of the 6-year mark, yields of around 8.5% versus cash, you can see about 2 percentage points lower. And again, if you think about what the yields are then on the sort of, let's call it the 5 to 10 year, competing very, very favorably with what we just saw out of the listed property sector, and with relatively low risk. And then obviously longer duration, you get a nice yield pickup, but we have a preference for sort of shorter dated paper. And I think on average, the SA bond index has duration of around 7 years. So just a very quick example of how the bonds have performed. We hold the Satrix Govy or Satrix All Bond Fund as a clean, simple way of just tracking the benchmark duration. There you can see that fund has done very, very nicely. If you look on the top right table, you can see the 1-year performance of 16.3%, and the 3-year at, these are all annualized at 12.8. So although the listed property index has done well, arguably we've also done reasonably well while we've been in bonds. We've got a very small holding. We reduced it actually in the period in inflation-linked bonds, and there you can see performance a lot more disappointing, sort of just under 6% on a 1-year view, and the 3 years around 6.3, and that's obviously as inflation is compressed, and that's in large part why we sold them quite some time ago. All right, then I think what everybody's interested in, the equity bucket. Just a few high-level comments. We've said this before. We've got a value bias, but we're not fanatically value-oriented. We are very differently positioned to the benchmark, as you'll see, and as we've discussed in the past. We've got quite a lot of exposure to South African financials, as we'll show you later, mainly on the valuation argument. We are fairly underweight resources and have been very, very underweight resources for some time, but we have been increasing that exposure, as we'll show in a second. Yeah, we retain quite a lot of exposure to net asset value plays, but that's actually shrunk quite significantly with the delisting of African Rainbow Capital, where we took our weighting from about 9% down to 3%. And you can see EPS plays, we believe, on very, very low valuations. And we are not afraid of small and mid caps. And we believe that they offer smaller investors, such as we are in this fund, relatively speaking, a unique opportunity. Right, the equity bucket, just looking at how it's changed over the last 6 months. On the right-hand side, you can see the portfolio as at the 31st of December 2024. African Rainbow Capital is really the big change there. It was 9.9% of the portfolio. As at the end of June, it was sitting at 4%. We got special permission from the trustees of the fund to continue to hold the unlisted asset. A couple of the others there you can see, if you look at Anglo American, we didn't really change it very much. We slightly rebased the smaller holdings. You can see the smaller holdings there, sort of around 10 o'clock, gone from 1.7 to 6%. And that's just really so that we can focus our energy and time more on some of the bigger caps in this presentation. Some of the positions that changed quite significantly, Aspen obviously from almost 6% down to 4%. We did trim it a little bit when it had a good rally just before the March results. And obviously the share price weakness there also contributing. BHP we actually increased, but you don't really see it on this graph. Yeah, Ethos Capital went up quite significantly, mainly on the strong performance in the share. Yeah, but the rest of them, things like Old Mutual up a little bit, 91 up a little bit. It's really just us allocating a little bit more capital, and some of that was obviously just as we reallocated some of the African Rainbow Capital proceeds. Yeah, and then companies like Standard Bank, largely steady, ABSA also largely steady. So not massive changes in terms of the bigger holdings. If you look at, as we say, just some of those the red ones there are the sales. You can see African Rainbow Capital, Aspen, Bell, Ethos has actually gone the other way. Apologies, that's an error. Cupper's come down a little bit. Yeah, Naspers, we did trim those a little bit. And then we have been adding to Argent and Anglos and Mondi and a couple of others. Yeah, we showed this last time, and it's always important to remember because we are very differently positioned to the index. If you look, we have around 6% invested in Naspers. You can see there in terms of the current Satrix, or sorry, not Satrix, the current Swix weighting between Naspers and Prosus sitting at almost 90%. Goldfields and Anglo Gold also now representing about 10% of that fund. So the JSE top 40/Swix continues to evolve and to morph, and it just strengthens our view that one must remain focused on buying underlying companies rather than tracking these very, very fluid indices. So we continue to be very differently positioned to our equity benchmark. Very quickly, some of the more recent activity, it's obviously difficult to capture everything. Some of the additions in this 7 months, we bought some Valterra, but we also received an unbundling from Anglo American. We're quite bullish, as we've discussed previously in local market review, on the outlook for Valterra. We added Anglo American, which we see more as a corporate action play, and BHP Group. We bought Mondi and Quilter. We added some Standard Bank prefs, particularly using some of the cash from the ABSA pref delisting. And then we added, as we often do when we see weakness in things like African Rainbow Capital earlier in the 6 months, 7 months, Ethos, 91, Coronation, etc. Some of the positions that we sold or reduced, African Rainbow Capital, as we said, with the delisting, we sold some and then obviously accepted in the offer. We reduced Bell, we continued to reduce Bell after the delisting. We sold most of the Rainettes a little bit ahead of the corporate action on Pension Insurance Corp, but we're happy with the performance we've derived there. And as we indicated in the local market review, we'll now wait and see what the family basically decides to do with that structure. We trimmed some more NASPAs, taking the view that excessive weightings are not prudent. And then we also obviously sold ABSA just ahead of the delisting. ABSA Pref, sorry. Just looking very quickly at the June 30th minimum disclosure document, performance a little bit disappointing. If you look on a 1-year view, performance 17%, obviously come off from what we saw in December, still beating the ASISA category, and importantly, it's beating the ASISA category on all 1, 3, and 5-year periods, although quite marginally. And then you can see the chart there, and I think important for us is we tend to be a little bit less volatile in extreme markets. Having said that, we think that the risk of the underlying benchmark and the ASISA category, particularly if you look at the ASISA category at 4.4%, that standard deviation just feels a little bit unnaturally low. So our risk, our standard deviation, a little bit higher than the market, which we would normally be worried about. But as we say, our feeling is that standard deviation and risk metric is actually artificially low. And then moving on to the TIC, the investment charge, as we illustrated before, we expected it to stabilize just below 1.3%, and that's exactly what we got. You can see, it's come off very, very nicely and sitting around the 1.28, 1.29%, and that's where we expect it to remain. Distributions remain steady in spite of lower interest rates. You can see in December 24, a distribution of 2.78 cents per unit and 2.71 cents in June 25. That combines to give you an effective yield of 3.9% on the unit price. Then just very quickly comparing it to the 31 July MDD, performance was very disappointing in the period. You can see 11% versus an ASISA category of 15.8. Longer term, though, if you look at 5 years, for example, still beating the ASISA category by a few percentage points, although not materially so. And the risk metrics look much the same, so I'm not going to dwell on those. The fund outlook, we believe the fund is very, very well positioned, right asset mix, and we've got high confidence in the equity bucket. We'll illustrate that in a second. And we continue to believe that the equity bucket offers asymmetric returns on the upside relative to the downside, particularly on the medium-term view. We remain rooted in a fairly cautious philosophy, but are open-minded in terms of opportunities, as we maybe could use the example of the investment into Valterra as an opportunity. And then the reason we maintain the fund is well positioned from an equity point of view. What I've taken here is the earnings per share plays, and you can see the weight in the fund, the PE ratio, and the historic dividend yield. As you can see, ABSA, biggest holding at 5.3% of the fund. That's not of the equity buckets of the actual fund. And you can see their forward PE of 6.3 and a dividend yield historic of 5.8. The forward looks a lot better than that. Standard Bank 5%, dividend yield almost 8, and a PE of 8. I'm not going to run through all of them, but you can see basically only 91 and Valterra are on PEs, forward PEs of 10 or more, and on average you're getting a dividend yield probably there of around 4% on average, if not a little bit better. Obviously, some companies like CUP, which are just outside of this universe, the dividend yield there the dividend has been cut, but still we believe we're very, very well placed for a re-rating of SA Inc. And just on the NAV plays, you see Ethos, Naspers, Remgro, and African Rainbow Capital still trading at very, very nice discounts of 35% or more. So with that, we thank you for your time, attention, and for our investors for your ongoing support. I'll say that the 6 months to June and the 7 months to July were a little bit disappointing. Maybe a market just losing a little bit of fizz. You still get the feeling that the overriding mood in the market is, divest SA and invest offshore. We think that that's not wise at this stage, and we believe that the equities that we hold, if nothing else, will give you a good shield in difficult times, but we believe offer significant outperformance opportunity if we see just a little bit of good news flowing. We trust this has been informative and useful. If you have any questions or comments, we really do encourage you to reach out, and we thank you again for your time, attention, and support.